Money makes the world go round, but smart investments make your money grow. Investing your money wisely can seem like a tricky puzzle, especially when you're looking at putting a big amount like $100,000 into the mix. Two popular choices among investors are VOO and SCHD, each a type of ETF or exchange-traded fund. Today, we're going to compare the two funds on all investing metrics and see which one comes out on top. You'll see how they match head-to-head on their past performance, current performance, and what their strategies are for return. We'll see who wins the price appreciation round, expense ratio, dividend, and risk factor rounds. In the end, we'll show you a side-by-side projection for the long term with a $100,000 one-time investment. Both have the potential to make you a millionaire, but one of them can double the return. First, let's do some background checks on these ETFs, starting with the Vanguard S&P 500 ETF, popularly known as VOO. It's an exchange-traded fund that offers investors exposure to the large-cap segment of the U.S. equity market by tracking the S&P 500 index. This ETF is designed to provide investment results that, before expenses, correspond generally to the price and yield performance of the S&P 500 index. The fundamental investment strategy of VOO is to invest in a wide range of large U.S. companies, mirroring the diverse and comprehensive nature of the S&P 500, which includes leading companies across various industries. A key aspect of VOO's appeal is its historical performance. As an index fund tracking the S&P 500, it has mirrored the index's long-term upward trend, making it a staple in the portfolios of investors seeking growth through exposure to some of the largest and most established companies in the United States. Additionally, VOO is renowned for its low management fees, which is a hallmark of Vanguard's approach to investment products. Lower fees mean that more of an investor's money is working for them in the market, a crucial factor for long-term investment growth. VOO's major holdings reflect the composition of the S&P 500, with a significant presence in technology, healthcare, consumer services, and financial sectors. This includes heavyweight companies like Apple, Microsoft, Amazon, and Alphabet, which dominate the market in terms of market capitalization and have a significant impact on the overall performance of the ETF. And now our second ETF is the Schwab U.S. Dividend Equity ETF, known as SCHD, which takes a slightly different approach. It focuses on dividend-paying stocks, making it an attractive option for investors seeking regular income along with potential capital appreciation. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is composed of high dividend-yielding companies with a record of consistently paying dividends. The emphasis is on quality and sustainability, selecting companies that have a minimum dividend yield and a history of consistently paying dividends. SCHD's performance history has been marked by not only capital appreciation but also by the income generated through its dividends. This dual focus can be particularly appealing during times of market volatility, where dividend income can provide a buffer against market downturns. The ETF's fees are competitive, aligning with Schwab's commitment to promising cost-effective investment solutions. In terms of its holdings, SCHD includes companies with strong financial health and a history of dividend growth. These holdings are typically spread across various sectors, with a notable presence in consumer staples, industrials, and information technology. This diversified sector exposure ensures that SCHD is not overly reliant on any single sector, which can be beneficial in navigating different market cycles. Both VOO and SCHD offer distinct advantages, with VOO providing broad market exposure and SCHD offering a focus on dividend income. Their differences make them suitable for various investment strategies and goals, highlighting the importance of aligning ETF selection with individual financial objectives. Now, when comparing the performance of VOO and SCHD, it's essential to look at their historical returns and understand how they've fared in different market conditions. VOO has historically mirrored the performance of the U.S. stock market. In periods of economic growth, VOO has typically shown strong returns, reflecting the success of the large-cap companies that dominate the S&P 500. For instance, in the last decade, the S&P 500 has seen significant growth, barring certain years with market downturns or corrections. This growth trend has been mirrored in VOO's performance. SCHD, focusing on dividend-paying stocks, has had a different performance path. While it may not have matched the high growth rates of VOO in booming markets, it's provided consistent dividend income. This consistency can be particularly valuable in volatile or down markets, as the dividends can offer a buffer against falling stock prices. But it's also a goldmine for the long-term reinvesting dividend strategy. In the end, I'll show you how, even with relatively low share price growth, SCHD competes with VOO when $100,000 is invested in both. The performance of SCHD is reflective of the stability and reliability of its dividend-paying companies, which tend to be less volatile compared to the broader market. In bull markets where the stock market is rising, VOO tends to perform very well. This is because it's full of high-growth companies whose stock prices are climbing. However, in bear markets, when prices are falling, VOO can see significant declines due to its focus on growth stocks, which are often more sensitive to market downturns. SCHD, on the other hand, might not reach the highs of VOO in a bull market, but it tends to hold its value better in bear markets. This stability is due to its focus on dividend-paying companies, which are often more established and financially stable. These companies can still pay dividends even in tough economic times, providing a source of income when stock prices are falling. In the year-to-date period, VOO achieves a 2.94% return, which is significantly higher than SCHD's 1.19% return. Over the past 10 years, VOO has outperformed SCHD with an annualized return of 10.31%. While SCHD has yielded a comparatively lower 8.201% annualized return. This chart displays the growth of a $10,000 investment in both assets. But these charts don't mean VOO is a better investment. In fact, when it comes to investing, there are various approaches and philosophies that investors can adopt. Two popular methods are growth investing and dividend investing, each with its unique characteristics and goals. Understanding these can help investors choose between ETFs like VOO and SCHD, which align with these different strategies. First is growth investing. This is about buying stocks of companies that are expected to grow at an above-average rate compared to other companies in the market. The idea is to invest in companies that have the potential for high future earnings. These companies often reinvest their profits back into the business rather than paying them out as dividends. This reinvestment might be used for research, development, expansion, or acquisitions. The goal for investors here is to benefit from the rising stock price over time as the company grows. VOO fits well into this growth investing philosophy since it tracks the S&P 500, which includes many of the largest and fastest-growing companies in the U.S. It's an excellent vehicle for investors who believe in the continued growth of these companies. VOO's broad market exposure means investors are essentially betting on the overall growth of the U.S. economy and its leading companies. On the other hand, dividend investing focuses on companies that pay regular dividends. Dividend investing is often seen as a more conservative approach, as it provides a stream of income regardless of stock market fluctuations. Investors who prefer a steady income, along with the potential for moderate capital appreciation, might lean towards dividend investing. SCHD is aligned with the dividend investing strategy. It targets companies that have a history of paying dividends, indicating financial stability and reliability. These companies are often well-established and have a steady performance record, making them appealing to investors who prioritize regular income and lower risk over high growth. VOO has an expense ratio of 0.03%. This low expense ratio is one of its appealing features, as it means lower costs for investors. Lower expense ratios can have a significant impact on long-term investment returns as they reduce the amount deducted from the investment for fund management. The expense ratio of SCHD is 0.06%. Up to now, we have VOO winning the share price appreciation bracket and lower expense ratio bracket. But what about the dividend factor and risk factors? Currently, Vanguard S&P 500 ETF VOO has a dividend yield of 1.91% and a dividend growth rate of 7.42%. Respectable, but when you compare those numbers to SCHD, it tells quite a different story. SCHD has a current dividend yield of 3.45% and an average dividend growth rate of 11.39%. This clearly shows that SCHD is dividend-focused, and with that, it wins in the dividend bracket. Now, coming up at the end of the video, we'll show you a side-by-side comparison of a $100,000 investment in both ETFs and see which one comes out on top. Which one do you think can double the return of the other? We'll find out shortly. But first, let's analyze their risk profile. When assessing the risk profiles of VOO and SCHD, two critical factors to consider are volatility and sector exposure. Volatility measures how much the price of an investment fluctuates. High volatility means the price can change a lot in a short time, while low volatility indicates more stable prices. Typically, VOO, which tracks the S&P 500, has experienced moderate volatility. This is because it includes a mix of different kinds of large companies, which balances out the ups and downs. SCHD, focusing on dividend-paying stocks, generally shows lower volatility. These stocks are often from more stable, established companies, so their prices don't jump around as much. Then there's sector exposure, which refers to how investments are spread across different business sectors. VOO, being a broad market ETF, has diverse sector exposure including technology, healthcare, consumer services, and financials. This diversity can help reduce risk because if one sector's doing poorly, others might be doing well. SCHD, on the other hand, might have a different sector focus due to its dividend-paying criteria. The sectors in SCHD are likely more balanced and focused on long-term stability, like utilities or consumer goods, which are traditionally more stable and less prone to sudden market changes. All in all, both ETFs are relatively in the stable region. But does that mean they offer the same return as well? Not at all. There's quite a difference. Here's the side-by-side comparison of John's $100,000 over the 30 years in both ETFs, starting with VOO. From our discussion up to this point, we know VOO has a dividend yield of 1.41%, a dividend growth rate of 7.42%, and a share price appreciation of 10.31%. Based on all these metrics, if John invests $100,000 in this ETF, after 1 year the investment rises to $111,720. After 10 years, the investment is projected to almost threefold and reach $298,330. Give it 10 more years, and after 20 years, the portfolio value will reach $865,178. At the 30-year milestone, John's initial investment of $100,000 will reach a solid $2,456,558, paying $13,342 in annual dividends, or $1,112 monthly. That monthly dividend is low, but as we said, this ETF is growth-focused instead of dividend-focused. The overall addition to John's portfolio is $2,356,558, with $2,192,682 deriving from a stock value increase and $163,876 from reinvested dividends. Good figures, right? But are they better than SCHD? Let's find out. We know that SCHD has a current dividend yield of 3.45%, a dividend growth rate of 11.39%, and a share price appreciation of 8.2%. This means that if John invests $100,000 in this ETF, after 1 year the investment will be valued at $111,650. After 10 years, the investment is projected to grow more than threefold and reach $315,873. Give it 10 more years, and after 20 years, the portfolio value will reach $1,136,616. And that is where the compounding from dividend reinvestment takes charge. At the 30-year milestone, John's initial investment balloons to an impressive $4,875,243, paying $358,056 in annual dividends, or $29,838 monthly. The overall addition to his portfolio is an extraordinary $4,775,243, with $2,552,160 deriving from stock value increase and $2,223,084 from reinvested dividends. So, the final takeaway based on these projections is that SCHD is a more favorable investment choice when compared to VOO. Over a 30-year period, SCHD has a superior performance in several key aspects. It has a total value added of $4,775,243, significantly surpassing VOO's $2,356,558. The standout difference, however, lies in the total dividend reinvestment, with SCHD offering a substantial $2,223,084 compared to VOO's $163,876. This is why SCHD provides a significantly higher annual dividend income of $358,056 compared to VOO's $13,342, which means its monthly dividend income of $29,838 far exceeds VOO's $1,112. Now that you've seen how SCHD is better, check out our video on how much SCHD do you need to retire.